Welcome back, everybody, to session number 3 of The Business of Writing with Craig Martell and Joe Solari. I am Joe Solari.
And I am Craig Martell, coming to you live from the site.
All right, so today we're talking about taxes. This was a big topic for folks out there. You provided a list of questions from the group that was for the conference. I think some of these things we're going to hit on. Some of them I think are best left to other folks because they're pretty specific. So we'll weave those in. But we kind of laid out a schedule before that. And, to begin with, let's kind of talk about taxes from the expense perspective. We started last week, we had our tracker, and there was an area there on expenses, and I showed some general business expenses. But I think if we start out, Craig, with you talking about how you would do it on a Schedule C, and just, and let me take a step back. In all these cases, even if you're a very sophisticated author that's going to set up an LLC or an S Corp, in the end, we're going to have you, it's all going to flow back to your personal taxes and your personal tax rate. That is an important thing to keep in mind, so that we're not going to ever set up a thing where you're paying a corporate tax and then paying personal tax. You don't want to get the double taxation piece. So, and later on we'll talk about corporate structure, but in the end, in the beginning, you're going to want to do this on your personal tax return with your Schedule C, and then as you move forward, you're going to be doing it within the company and filing a return for the company, which then will have what's called a K-1, which flows back to your tax return. So that's kind of the higher level stuff. To begin with, and for most of us, a Schedule C is perfectly great way to track your expenses. So why don't we go from there?
Yep. The first, when it comes to taxes, the first order of business for an author, especially if you've got a day job, you've got this other stuff going on, and you're just getting into the author business, you need to make the money in order to deduct the money. You can have a carryover from year to year. However, you can't deduct it if you don't make it. So if you're just at the hobby level making $2,000, $3,000 a year, you can only deduct $2,000 to $3,000 a year from those activities. So if you're $1,000 a year and you take the family on a trip to Hawaii, you're only going to be able to deduct $2,000 out of that. So you need to make enough money to cover those extra expenses. And if you're doing it full time, then you really need to control things so you aren't getting eaten alive by your taxes, because you also need to pay your self-employment tax. For me personally, above my expenses, I set aside 40%. So if I make $10,000 in a month profit after expenses, aside $4,000 to send to Uncle Sam, because then you're safe with the Social Security, the contribution rate, the self-employment tax, as well as your personal tax rate. So that's just a general, here's how to do it kind of cocktail napkin thumbnail sketch of taxes.
Yeah, and on that point, as far as Uncle Sam's concerned, if it's more than $400 of profit, he gets his share. And you mentioned the self-employment tax on the federal level, it's 15.3%. And then that's on top of whatever your personal income tax rate is. So if we're talking individuals, and you make between, 0 and $9,000, that's 10%. So now you're already at 25%, right? And then you move up if you're 9 to 38,000, and it's 15%. So now you're at 30%. So your number because you're taking self-employment plus like last year's tax rate, right?
Yep. Yeah. Because I pay between 20 and 25% tax rate.
And that changes too. Like the numbers I just talked about were for an individual. If you're married, those numbers are different. But the key thing from what you were saying is, have that chunk that you're setting aside. It should be more, not less, right? That is the most obvious mistake that people make is something's going to happen in the future that's going to make this money appear that I'm going to be able to pay taxes on April 15th. And, what that gets you is a payment plan with the IRS.
Which is an unhappy position to be in.
Yeah, I mean, there's literally millions of people a year that do that. So don't be that person, right? Like, you've got a good rule of thumb, 40%. For some, it might be less, but have that stuff set aside. So why don't you talk a little bit about, tax or expenses against still, and what you're deducting, and maybe talk a little bit about if there's some things that you feel are different for authors from other businesses, right? Because like all businesses have the ability to deduct expenses. So if there's anything that you think might be a little different, then maybe you could touch on that.
The biggest difference, I've run a number of businesses. The biggest difference for an author is being able to deduct what other people would consider our vacations. You take your family fee. You can deduct your airplane ticket. You can deduct your hotel room. You can deduct a per diem of your meals. That's the easiest way, is you just get the per diem rate for Hawaii and deduct that as opposed to actual cost. Because you can get inspired, you take some notes, you write a short story, you set a scene in your current work. No matter where you go, write something, get inspired, go sit on the beach and write a few words in your novel, even if they have nothing to do with Hawaii. You can still document, because the IRS absolutely doesn't understand how authors work, but they give you the benefit of the doubt. So the huge difference is you can go on vacation and you get to deduct that. For me, that means if I pay $1,000 to go on a trip, it's only going to cost me about $600 at the end of the day, because that's 40% I'm not sending to Uncle Sam.
Mm-hmm.
So it's like getting this massive discount to go on vacation. Sure, you have to make the money to deduct the money, but if I made $2,000, I'm perfectly happy not sending $400 to Uncle Sam and paying $1,000 and going on a vacation somewhere.
Yeah, and I think you hit on a key point there. What expenses provide as a tax shield, right? As you move forward, if you have the money to support it, then your cell phone bill should be on there. Your internet bill, the things that you're using to run your home office can be deductions.
I actually don't deduct my home office. I don't deduct anything there, because it opens a doorway that I don't want to open for the federal government.
Well, so you're talking about the deducting the home office portion of your home?
That's right. Yeah. And I don't deduct my internet because I don't use it exclusively for my business.
Okay. And that's now, that. I think the caveat there is it's what you're comfortable with. There's a lot of people that do deduct that stuff. If you want to play it super safe, then you can run it like Craig does and not touch anything for your office. The real key thing is, and what we're talking about, the home office deduction is, you can take a portion of your mortgage that you pay on your home, and it's based on a square footage, and deduct that as an expense for your business. The huge problem with that is this. That means that when you go to sell your home, you lose the homeowner's primary home exemption on capital gains tax on that, and you have to pay capital gains.
And that is one of the questions that we've asked our tax professional to answer for the show, and we should get something back in writing that we can share with everybody, even if you're not at the 20 Books Vegas convention.
Sure. And maybe that when you're talking to that person, it could be kind of an A and a B, like, what's your recommendation? But if you so choose to do the home office deduction, how does it work? Right. I can't really speak to it. I just know that we would never do it at our place. I mean, both my wife and I work out of our office, but given where I live and home values, that would be a huge hit when we sold the house.
Yeah,
we had to write that check. So
and also you automatically give access to government officials to come into your home.
Yeah, I didn't even think about that.
Because they can come in and verify. And no need for that. I worked long enough in the federal government. There's some overzealous people, and I don't want to give them access without just cause. So.
Yeah, no, that's a good point. So, and just a little bit more on expenses, kind of my rules of thumb, you don't want to be in a position where you're not paying some level of income tax. I understand when you're starting up a business in the first couple of years, it's usually a reality that what happens is that you have more expenses than you do income. I mean, it doesn't matter what you're doing, writing books or designing software. That's just the nature of the business. But once you are making money, you should have a kind of a gauge, just like we were talking about with how much personal income you take out of the business, with what kind of expenses you put on that business. Because if you're not paying income tax, or it's $100 every year, you're going to have issues when if you get audited. It's actually pretty hard to get triggered for an audit, but if you do, it's going to be hard to do that, hard to justify your expenses. Now, what we'll show as we go into some of the higher level stuff where we start paying ourselves a salary, there becomes this balance, right? Because what's ending up happening is you are paying income tax, but you're paying it on a portion on the salary and a portion on the business, right? And so as long as we keep those ratios right, and I know people are going to ask those questions, like what should those ratios be? We'll give some rules of thumb later on, but the whole idea of this thing is to be a successful author that makes money and you pay your share of taxes, right? As you walk through this, you should be able to not feel like you're overpaying.
Yeah. One of the rules of thumb in order for deducting your expenses are if you need it. You can't go and buy yourself a nice statue for your home office and then try to deduct a $10,000 piece of art or something like that. You can, but that's problematic. What do you need? You need pens, you need pencils, you need your computer, you need the internet, you need, if you go and travel, you need a hotel room, you need a flight, you need even our travel, a movement, surface transportation, you need to eat. There you go. Anything else, like you don't need to get a beach towel for $8 on Waikiki. Trying to deduct that might be a step too far. But what do you really need? And if you use that as a rule of thumb, like to live, I need the hotel room, I need food, I need a transportation to get there, and I need the airplane ticket. There you go. I parked at the airport to go to that trip. Yeah, you can deduct that. All of that is good stuff, straight one-to-one. Food isn't necessarily, but everything else is one-to-one. You spend $1,000 on a plane ticket, you deduct $1,000. Mm-hmm. That's pretty cool. For a question I have for you, Joe, is in regards to taxes. You talk about tax shield. What can an author who is writing full-time do to even one who's writing part-time? What's their income threshold for contributing to a tax-deductible IRA?
At any level, you can set up a SEP or an IRA. And it's funny you bring this up. This week I'm going to have I think a really great blog on this subject that's going to get into some of those specifics that talks a lot about SEPs and IRAs and 401ks. With an author, there's some real tax advantages to a SEP and the amount that they can contribute and how they can bring in income from the business into that SEP.
And not have to pay any taxes on that chunk.
Yes, and in some cases you're deferring the taxes, right? You're not paying the tax now.
Yes.
You're going to pay the tax in the future, and the concept being that you'll be at a lower tax rate at that age, and that money will have the opportunity to grow bigger in that account.
Correct. Yes, exactly.
So yeah, they're going to get their money sooner or later. With the IRA, you can set up a Roth IRA. And I'm not an investment advisor, but this blog I did put together with actually my investment advisor, my money manager. And with the Roth IRA, then you pay the taxes today. And the way it's built is then when the money comes out, you don't have to pay any taxes on it, unless the government changes all the rules.
Yeah, right now, yeah. I can't deduct my IRA contributions, but down the road, when I pull them out, that's all tax free.
Yes.
Because I'm paying taxes on that money now.
Yeah. Now, one of the things that I'll talk about in that blog, I don't want to get into it on this one, but we're going to talk about as far as operating your business, the use of a 401k. And whether that's your 401k that you have now at where the business, where you're working at your day job, because they may offer a 401k and you've been investing in it, and how you can use that for some startup capital. But then also why you would want to use, once you're making some money as an author, why you'd want to set up a 401k for your own business. It has some huge advantages for how you manage your retirement and how you do profit sharing, right? So it gives you a function where you can defer some of the income tax on your own salary that you would be paying yourself, plus profit sharing that goes in there. And it can be a little confusing, so it's better if you kind of read it to understand it. But it does have some definite advantages over a SEP or an IRA. Certainly, when it comes to paying taxes, I think you hit on a good point. Is that there are, besides your expenses, if you're a self-employed writer, you need to be thinking about your retirement, and there is tax deferment in retirement.
Good deal. That's it. Yeah. That's it. That's all I was looking for. Just there are options and something to consider. Write it down, write a note, and say, hey, I need to think about this, because we have some young authors. Younger is better for putting into your IRA or putting into a SEP 401k, because you can put in less for longer time, and you're going to make a hell of a lot more than at our advanced age, trying to throw in large quantities and hoping to retire in 10 years.
Well, I think that's the same as we were talking about, hoping that you're going to have the money to pay your taxes, right? Like there's a lot of people that are looking for that home run hit to take care of retirement. And, and I know in my case, I had really good advice from my parents and an uncle about investing and money. And so the day I started my first job and I was making minimum wage and I had an opportunity to, put savings, I put, a portion of that into a savings account. And once I got a 401k at the first place I worked, I put in the maximum I could, because I understood that that company matched that money to a certain point. They match that money. Mm-hmm. And what happens is if you do that, what you say you set it up to be, I think it was a maximum of 10% of your income, you learn to live on that, or you should learn to live on that. Right?
You learn to live without that. That's right.
Yes, good way. That's right. Good way, right? And then as your salary bumps up, that just automatically ratchets up, and you don't realize it. And then, in my experience, that money, like you said, that I invested 30 years ago, is, and there's been some massive shifts in the market, right? Is grown to be a significant amount of money, right? And that's really how you create that kind of wealth, as somebody that's, a wage earner. The problem you have when you become a business owner is you're struggling with the concept of, what's this dollar going to go to, right? So the thing to keep in mind is if you are investing it in the business, it should have a better return than the S&P 500. Otherwise, why would you put it into this business?
Yeah.
Right. So, and that makes you then think that what we're talking about now is like this dollar that's in the business, does it really need to be spent on X or Y? Is that expense really needed, or should it be better used, to make a better book cover? Or is it better that it comes out of the business and goes into my retirement plan? You have to be schizophrenic as a business owner. It's something I always talk about. You need to be thinking sometimes as the business manager, and then sometimes as the investor. And as the investor, it should just be like, where's my money? And if you're not delivering that, then you really need to step back and say, okay, why would I leave that dollar in the business?
And that's important. Important business points in regards to tax, as well as just an overall strategy for managing business as an independent author, is you want to pay yourself first. You've got to pay Uncle Sam. So if you could carve out 50% of your profits to do those kinds of things, and the other 50% you plow back into covers, editing, marketing campaigns, whatever it may be. But if you got to get into that habit of paying yourself first. If you do that, you don't have to make vast sums. You don't have to make 7 figures a year to have money, to build wealth. If you start putting that little bit away now, that 10% piece, and just put that away, don't touch it. It's not investable. It's separate. It's for your future. You do that, and you're going to see great things. At some point in time, 10 years down the road, you're going to be, I've been self-publishing, but I haven't had that runaway bestseller with 100,000 copy sales. I mean, I haven't. I've sold, maybe 25, 30,000 copies, but I have a big backlist. It's still, I don't have that one home run where I have that one that sold 1 million copies, that I made enough that I got that big chunk, the home run you talked about. You don't need that. Walmart doesn't make home runs. What they have is a bunch of bunts and a bunch of singles, and they make huge amounts of money because they have a small volume, or a small margin, but they sell a huge volume. If you do this with that small investment in yourself, every month you take that chunk and put it away, and then over 120 months, 10 years, you're going to see that money. Hey, and say, I actually have I have a nice chunk. Maybe even you put that into buying a home. You buy a home. How good is that? That's investing in yourself, because that's something that you can take to retirement and you sell as you move on. I mean, homes aren't the investment they used to be, but they shouldn't be. They shouldn't be something where you're counting on it to appreciate tenfold between when you buy it and retire. It's a place to live. It's a place to enjoy. Your IRA, your 401k, your SEP, those are where your wealth is. That's how you, even a savings, something where you've got this money set aside, lower risk. You want to lower that risk because of you want to have it. You don't want to throw it in growth and income funds across the board and hope that the emerging markets fund takes off or something like that.
Yeah, that the guy picks the next Facebook, right?
But that's, I'm going to dump it all in Instagram stock. So no. Look at paying yourself, and that's part of the taxes, part of the chunk out, but that's the business of writing. You don't have to have that runaway bestseller to, in 20, 30 years, when you decide to hang up your computer and call it a career, and have decent money that you can use to live comfortably. And then you will have been more successful than most people.
Well, and you and I were talking before we started this about some kind of advanced concepts with authors. And what I would argue is that an author's business is far more valuable if they have a large portfolio of books that have steady sales all the time, rather than home runs. Because home runs, they peak and then they burn out. And if there's a portfolio that's consistently selling, the same amount of books month after month, even after they've been, launched years ago, somebody's going to look at that and say, wow, I mean, that's a sustainable cash flow that's worth some money, right? Whereas if you are the kind of author that can write a book and boom, it goes and then it disappears, the only way that that's sustainable is if you keep writing, right? One last thing I wanted to hit on expenses. This is one that some folks get a little wound up with, is meals. And you touched on it in the beginning, talking about traveling. So when you travel, you have your travel meals. Now, you gave a good example of, say you're on with your family on vacation. You can go to the IRS site and see what's deductible for, or what they give for per diem for meals, and use that and charge that off. If you're on your own, if you're just traveling on your own, it's pretty easy. You just keep your receipts. And that's the other thing. If you're going to do this stuff, if you're going to start using expenses against your business, you can't just like, hey, I'm gonna charge this off. You need to keep records, right? You have to have the receipt from that meal, and you need to save it for years. So you have to have a filing system. But yeah, if you're on your own, like going out to this conference, all those travel meals will get charged at 100% of their value as a deduction. There is another deduction for businesses for office meals, which is 100%. Now, that's fine if you're Facebook and you're providing 3 meals a day to your employees, because you work them like sled dogs and you never let them leave the building. They can deduct that as an expense, but that's one of those things that gets to the home office thing. You better be really careful if on one hand you're saying you have a home office, and on the other hand you're saying you're deducting office meals. That's a trigger. And then the last piece is meals and entertainment. So, you take somebody out that maybe you're interviewing for your book, you buy them dinner, you have the right to deduct that against your business. But when it comes to paying your taxes, when you do file your Schedule C, or you're doing this through your business, only 50% of that is tax deductible.
Yep.
So that's the other thing to keep in mind, and when you're monkeying around with meals. Talking a little bit about when it makes sense to start looking at a corporate structure. And I think on the tax questions, there was somebody that asked about, tax advantages of an LLC versus a sole proprietorship. There really isn't any tax advantages to a sole proprietorship versus an LLC, as far as I can think of. Because in both you can have similar deductions. Where the LLC really comes into play is in protection of liabilities and your assets. It becomes a clear delineation of your assets and the business assets. Whereas a sole proprietor, I don't know how this would happen, but if you got sued for something in your book and, it was found that you were guilty of whatever it was, theoretically they could come after your house as a sole proprietor. In an LLC, they have to stop at the assets of the business. So it's not really specifically a tax situation. Now, once you're making money and you can start paying yourself a salary, there's some things you can do within an LLC to lower your tax burden with things like retirement and how you do some expenses in your salary. But we'll get into that in an episode on that. But more so, I think people are looking for, like, when should I do this, right? I'm a big believer in, you can set up a LLC yourself, or you can set up an S Corp, or when you set up an LLC, you can then make it subchapter S. You can do that yourself. I've got a free book on Amazon called Should I Incorporate? It goes through all that stuff, and you just get it for the fact that I've got all 50 states Secretary of State offices listed in there that you can click and go right to that link. But I think that you really should be, if you're like below $10,000 in earnings a year, it's a gray area. It may help you to have it just for organization purposes. If you're below $5,000 a year, I wouldn't worry about it at all. It's probably going to be a bigger pain in your ass to manage that, because the minute you do it, now you're not doing one tax return, you're doing 2.
Yeah. Well, and talking forms, let's talk about 1099s. If you pay somebody, your cover artist, you're going to pay them more than you're supposed to issue a 1099 if you send a single entity as part of your business more than $600. So you get 2 covers in a year, you're probably going to have spent more than $600. Do you need to pay? Do you need to issue them a 1099? Well, there's a huge gray area. If you pay them by a credit card or by PayPal, those electronic transfers are documented and they are supposed to report. However, the reporting threshold is $20,000. So between $600 and $20,000 is this huge gray area. You aren't required to report. However, there's no documentation at the federal level. If you can't be wrong if you do issue a 1099. You can do those for free online. You can, if you get TurboTax Small Business, QuickBooks, you can use those to issue those 1099s. I have an accountant and she does 1099s for me. If you do an anthology, paying royalty share to people, $10 is the threshold, not $600. If you're paying, and that's specifically in the instructions, it says that more than $10 in royalties. So that's not $600 on a threshold, it's 10. So you're supposed to issue a 1099. You pay everybody by PayPal. It's in that gray area. I do not issue 1099s because I have like 60 authors that I'm sending royalties to via PayPal. And so I've got all those records and I deduct all of that, of course. And it's their responsibility to put it as revenue. That's I've done my share. I do issue a number of 1099s, like my editor, cover artist. My cover artist is overseas. They work exclusively overseas. Do I need to issue a 1099? The answer is no. You may have to provide documentation that first they live overseas and second they did the work overseas. So it's not somebody from the UK comes to the US, does your cover while in the US. Now that doesn't meet those criteria. They need to do it overseas and then you don't need to issue a 1099. You're not required to by IRS rules. So $10 if you're paying royalties, $600, but the threshold is $20,000 for the company. So there's that big gray area between $600 and $20,000 in regards to issuing a 1099, which simply tells the IRS, hey, I sent this money to this person and I'm deducting it because it was a subcontractor. You don't want to pay them as an employee because then you take on a whole different gamut of really, really bad things that the government intrudes on your life and compresses your very essence of your being. So you don't want that. And if you do, well, then understand it's going to be a huge pain in your ass to manage that business while you're trying to write stories. Everybody you hire, your contractor, your cover artist, your editor, your proofreaders, your marketing guy, whatever, they're all subcontractors. You pay them as subcontractors. Don't try to deduct the taxes from it. If you start withholding taxes from those things, you have taken on the business ownership, which is a completely different element as opposed to a self-published author. You're now running a business more so than just you managing your own business, yourself, and the elements therein. Just understand what you're getting yourself into. Now you need to file with the state. You need to pay all these other taxes. You need to pay workers' compensation. There's all of that is very painful, and you can do it. I've done it. It's just if you don't have to, don't.
Yeah, and two really important points you hit on there. One is talking about if you want to kill the joy in a business quick, get employees. I mean,
Yes.
I've had several businesses with lots of employees, and I love working with other people. But you're the boss, and a lot of you'll be surprised what ends up becoming your problem, whether it's business or personal. It's suddenly your problem. And like you said, there becomes a whole range of issues that, especially with subcontractors or hiring people, if you have, a person that you have as an employee and you have them, I were talking about this. Even though you're in Alaska, if you have an employee in Pennsylvania considers your business operating in their state,
Yep.
and they want you to file there, and fulfill all your obligations, including workman's comp, including paying income tax. A lot of people that are using fulfillment by Amazon are now getting in trouble because they may be in a no income tax state, but their products are being sold and distributed out of, say, a distribution center here in Illinois. And Illinois is like, hey, where's our income tax?
I had that exact situation. I ran a business out of Pennsylvania from here in Alaska. I had 9 different taxes that I had to pay on my employee. I had workers' compensation. I had business insurance out of Pennsylvania. Pennsylvania gets their chunk of money. Mm-hmm. So we operated at a massive loss just so I just avoid some of the stuff, but we didn't avoid anything. We operated at a massive loss. It's you don't want to run a business that way. And a complete joy suck. Took all of the joy out of what we were trying to do. So I ended up closing the business after 9 months is all, because the state of Pennsylvania made it so damn painful to do.
Yeah, I think the other thing you reminded me of is when you're talking about 1099s, as authors, you're going to be issued a 1099 from all of your platforms that you publish on. Even if you don't get it in the mail, because you may have, when you were signing up, checked a box that said you were going to get it electronically, those guys issue those because, Amazon wants to make sure that their books are completely clean. So don't think that, oh, well, I only had, $600 in royalties. I'm not even going to worry about reporting it, because that's the kind of stuff that gets triggered because they have your social security number.
Yep.
That form gets filed with the IRS, and the computers will eventually kick that in.
And you get, as an author, especially if you go wide, even if you don't go wide, I got 12 or 13 1099s last year. I contributed to an anthology, got a 1099 for the royalties. I contributed to Amazon. Amazon, CreateSpace, Overseas Amazon, ACX, all of that stuff. Here's a flood of, and if you got a 1099, the IRS knows you got that money, so you better get it onto your tax form.
So yeah, I think we kind of covered everything we want to talk about. That if you're an author, I think the number really is around 10 grand in annual earnings that you start thinking about formalizing your business. Below that, the stuff we talked about using your Schedule C, and you can still use the forms that we provided to track and to kind of run it as a business, but you don't need to have all the formal stuff, because it's really not going to help your tax situation at that point, because the salary you're pulling out of there, it would be less than $100 tax difference. I would just calling off the top of my head.
With a lot of extra work, so
you would probably end up wasting it all in either your sweat doing the work or paying an accountant to do the extra forms. Because even though your business will be what's called a pass-through entity, it still requires it to have a return done on it, and business returns they're complex compared to, if you can believe it or not, to a personal income tax, because you have to do a balance sheet, and it has to tie off to the previous year. So I don't know, is there anything else that you wanted to hit on?
What percentage of food, lodging, tickets to museum and plane tickets? We address plane tickets, but not museums. If you go to a museum for inspiration, you go to a place where you get inspiration. Once again, as an author, you can write that off. Just document and keep records. Don't try to deduct it if you don't have a record of it. If you have an ancillary record, like it's on your credit card bill, but you don't actually have the receipt, you can write a note and say, hey, I ate at this, I lost the receipt. But do that at the time that you lost your receipt and stuff it into your folders. And there you are. You have to keep physical records. If you try to do everything online, which you can't, just make sure you've got it and backed up. Because if your computer crashes and it eats all your records, you now have no records. And it makes it very, very difficult to justify in case of an audit.
Mm-hmm. Yeah,
and time consuming.
Spend a lot of time recreating all that stuff for it. Yeah, and like what I do is at the end of the year with my tax returns for the businesses, I print out like I mentioned, I use Wave. I can print out a list of all of those charges on one form, and I have that there as kind of the place to go. I know in the end I would go back to because it's the real records is on my bank statements, right? Because I'm almost all this stuff is electronic for me. It's either PayPal or the debit card that I got with the Chase account. So
and that's a sole business account. No commingling of funds. Commingling is bad.
No,
so if you remember, nothing from this commingling is, and you got to make it to deduct it.
Yeah. Yeah, I think that's good. Now, next week we said we were going to talk about some higher level stuff, how authors could think about monetizing their cash flows. And this is really in preparation for a breakout talk that I'll be doing at the Vegas conference. But what I'm going to do is, the way I'll present it is I'm going to talk about how to think about your business as an investor, right? So even if you're not at that level, if you start having this mentality, it's going to just make your business operate better. So maybe you're only looking at a return on investment of $1,000 versus $100,000. The thought process should be the exact same. And this isn't just important for your business. You should be thinking this you can apply to any kind of investment you're doing. Sound good?
And there we are.
All right. Well, that was great. It was always good talking to you, Craig. I love these little sessions we have.
You bet.
And I will see you next week.
All right. Thanks, Joe. Thanks, everybody, for listening in. If you made it this far, good on you. Nothing like sexy tax talk to make your day. And if you were jogging and listening to this, well, you're probably running at a 1 mile an hour pace now because it has sucked the life out of you. Taxes, cool, taxes. Yeah. Good on you. Hey, thank you. You guys have a great week, and we'll see you next week.
Yep. Keep writing.